G'day and welcome to the Investor Motivation Podcast. My name's Robert Gowdy and
Amy Lehman again.
G'day Amy, how are you?
Surprise.
What happened last week?
Last week we were supposed to record a podcast and we did not.
Yeah, and we both looked back and we couldn't work out why it didn't happen.
Yeah.
We must have been elbow deep in lots of stuff at work.
Yeah.
So apologies for that, but we are back on deck and got an awesome topic to chat about today, and that is from our friend Farhan, who put in a topic for us to have a chat about.
Commented on a previous podcast, wanting to learn a little bit about gearing to invest in ETFs using products like the NAB Equity Builder. So we're going to detail that today.
About borrowing to invest, and that's something that happens in the property market all the time. That is a complete natural thing. Banks love direct property, residential property. It's lovely security for them. It's not a liquid asset. So it's easy to borrow money against property, but when it comes to financial assets where there's more liquidity, the banks aren't so generous.
More volatility that we can see.
Yeah, that's right. And higher interest rates because of that perceived higher level of risk in the short term. So I probably need to disclose too that our financial services license precludes us from recommending any gearing. And that has not been a problem to our business at all.
Not at all.
No.
Before we get into all of that, before you keep going forever and ever, on behalf of the Investor Motivation Podcast, I would like to pay our respects to the traditional custodians of the land on which we record this podcast and pay our respects to elders past, present and emerging.
All right, well, just on that point around licensing, since we've been self-licensed, probably around 5-ish years. Prior to that, I was authorised under licences where I could recommend using managed funds. So another disclosure point, I was always the biggest, by far, margin loan borrower in this business. By far.
So do you mean personally or as an advisor?
Personally, yes. So the risk always sat with Robert Gowdy, who understands markets very well. But over the last couple of years, when some key holdings, really went backwards, dealing with margin calls over a year and a half was, something that I had to put time into. And not stressful. I don't get stressed about these things, but had to deal with them. Had to find cash. Had to find security. It took thinking, and for the average person, that would be stress.
It takes up a lot of mental space to be able to think about that.
And
it's probably worth noting for those that don't exactly know what a margin loan is. That's when you borrow money to invest into an investment, and it can be anything. It's not allocated to the safer type ETFs that are diversified. You can invest in anything you want, anything as risky as you want. Speculative shares, anything you like. So
they do have restrictions on the type of businesses.
Okay.
They do. So let's say it's a more speculative one. You might be able to borrow a maximum of 20%.
Okay. Yeah.
50% for some, and in the past used to be 70% if it was the banks. So they did have different borrowing ratios depending on the asset. But when markets go down. And those ratios, while you can feel very safe, those ratios can change very quickly. And I do remember during the GFC, 2009, and it was when it was the toughest day, and it's when Commonwealth Bank got slammed, BHP got slammed, and it was when margin calls are coming through, and these assets were just being sold down. And it was a vicious cycle. As the shares went down, it was triggering margin calls, which then meant triggered sales. And
vicious.
So very vicious. And that was the GFC, and that was some really tough investing times. So I think it's worth noting that with debt comes risk.
Of course.
And I think I remember we replied to a comment on one of our podcasts that gearing or borrowing to invest is essentially always positive. No, it is not.
No, it's not.
So
and with shares as well, you've got to make sure there is a buyer for your sale of shares. So when it does go into a really vicious cycle like that and people are just selling and selling and there's not a buyer, how are you going to fund that margin call at the end of the day?
Yeah. So let's, I suppose, I've used gearing personally in the past very effectively for a handful of clients, but we've probably got to consider alternatives to that.
Yeah.
Alternatives like superannuation.
Yeah.
Do you need to take on large amounts of risk when you can achieve financial security by saving a lot of tax versus superannuation salary sacrifice? So,
because that's the thing, isn't it? Most people are saying they want to go into a borrow to invest so that there's the tax deduction on the interest on the loan. But there's much better ways to be tax effective than spend $1 on interest to save 30 cents of tax.
Yeah, and I think it's worth breaking that down, because that's when I was on holidays. When I was looking at some of the property spruikers online, the tax is just such a strong, the government endorsed strategy about getting your tax back to to pay for your loans. I don't like the wording they use, but it's are there more efficient ways to do it? If you borrow $100,000, and you've got an interest rate of paying interest at 8%, is an $8,000 deductible interest bill going to make a huge difference? If people on higher incomes at 200 grand, is 8 grand going to move the needle? So you've got 8 grand worth of interest, and you might get 4 grand of net rent. So is negatively geared, is $4,000 in deductible interest going to move the needle? It's probably not.
No.
The only way that strategy works is the value of in this scenario, that where the debt is higher, is that the value of the property goes up.
That's the kind of goal of it all, is you want to be investing in an asset that's going to grow more than your cost to have that asset.
Yes, which a lot of properties have done over the last 20 years. If they haven't grown over the last 20 years, they never will.
Yeah, that's right.
Yeah. So let's unpack, I suppose, ways that we can borrow, Amy.
Yep. So we've touched on margin loans. There are also home equity loans. So that's more in the podcast we spoke about the other week, where you can borrow a line of credit against your home, which then is used to purchase investments.
Right.
So
and that's generally, obviously, the cheapest loan you can possibly get.
Yes, because it's still linked to your home, and your home is there as collateral rather than the investment you're purchasing being collateral. So the house being generally a safe asset in the bank's eyes will have that cheaper interest rate.
Right. Yep. And I got some of what variable home loan rates at the moment, Amy? They're probably around that sort of 7-ish, are they?
Yeah.
Yep. And just by comparison, the one that Fran mentioned earlier, which was the NAB Equity Builder. I don't own shares in that for me to be mentioning them, but 9.75, and obviously we just had 0.25 increase, so that's probably 10%.
Yeah, 10% of your standard variable rate,
Yep.
And they will always discount, the special advertised rate, so join up and it might be an 8%, but 2 months down the track you'll be back on the variable 10%, so that's something to be wary of.
Get you in. So using your property, so if you've got some equity, and this was, again, you've got to be careful around this, because this was the Storm financial strategy, wasn't it?
Yeah.
Which was spoken about in the past.
Yeah.
Yep. Take your, draw equity out of your home.
Mm-hmm.
It didn't matter what age you were, whether you're a pensioner or not, grab some equity out of your home, invest that into a index fund, and then borrow against that index fund with a margin loan. So it was double gearing.
Yeah.
And people lost tens, or combined, it was over hundreds of millions.
Yeah. And would you say that's one of the reasons we decided to go self-licensed and not include being able to do margin loans?
Correct. We just, not a big part of the advice I give. I think the Storm Financial one was it was a sausage factory. Yeah, it was a cookie cutter. It was the same strategy for everyone, regardless of where they're at in life.
Yeah.
So even if a simple superannuation strategy with no debt was better, no one ever got that.
Mm-hmm.
And that's obviously part of the reason why our industry has changed so much in recent times.
Yeah. And that massive conflict of, borrow more personally, up your risk, and then we'll manage the investment from there. So we get a fee for you borrowing money.
Well, that's right. a lot of these clients didn't have money to invest, which meant the financial planning firm had nothing to do.
Yeah.
Apart from perhaps some clever co-contributions, spousal contributions, salary sacrifice.
Some massive value to add in a very safe and efficient manner.
Yeah.
But no, they truly upped the risk, and I think that was really what kicked off the Royal Commission into the banking and finance sector and cleaned up a lot of those players.
Yeah, including the banks, who are now mostly all out of financial advice. So, that's extreme. Double gearing is right in the extreme end. So personal loans, so an unsecured personal loan, you can use that for investment?
Yep, and generally probably the highest interest rate on personal loans, because it can be for investments or most commonly car loans or just personal things you want to get.
Yep. A line of credit can be like a home equity one where you can borrow up to 80%.
Yeah.
I think that's where you'd need to, like we spoke with debt recycling, where you'd be splitting.
Yes.
You're splitting the loan so you know what's a home loan and what's tax deductible.
Yeah. Your accountant would know that and do a tax deduction.
Very good. So let's talk about the benefits of borrowing to invest, Amy. What's your take on it?
Well, obviously borrowing more funds mean you have more funds invested into any shares, any stocks, any ETFs. So the returns that you get are amplified because you have invested more.
Right.
So it does, kind of give you a little bit more income before you might have normally been able to have that income.
Yep. So it can amplify obviously the returns,
as well as the gains.
Yep. So greater growth because you've got far more exposure, and that's I suppose why for the last 40 years in residential property world, it's just been mostly up.
Yes.
And all people have had to do is, and that's where it is the norm, to borrow large amounts of money, hoping that in the future from now it'll just continues to go up.
Yeah.
And so very accepted over here, but borrowing money to invest into the share markets around the world is quite a foreign. Why do you think that is, Amy?
Especially in the Wimmera, it has always been drilled into us, bricks and mortar, something that you can see, something you can touch. People will always need a home. That is ingrained into everybody, and it is weird as advisors to think, why would we hope that a house property is going to grow in value? Because how do you actually value a house? It doesn't produce any goods or services, and that's how we value businesses.
Yes.
There's people working within businesses to improve products and services and hence business profitability. But as advisors, what makes a property actually increase in value? It's nothing other than consumer, demand.
Yeah. So
really.
A bit of CPI, I suppose if we look at our commercial, and a bit of commercial property that we lease here, some CPI, which contractually at least goes up with the cost of living.
Yeah.
Generally, rents are in line with that as well.
Yeah.
And supply and demand, of course.
Yeah.
And low interest rates and government handing out more money.
Yeah.
So
governments don't want the property to fail, so
that's right. They want
have some money to afford to keep it.
Yeah, they want their constituents, their voters, to have wealth and to feel safe.
Yeah.
Which is understandable. And obviously, where the share market, whilst if we look over the long term, will average a higher rate of return, but the volatility just snookers everyone, doesn't it? It just, that volatility means in people's mind, that short-term volatility, that it's just risk.
Yeah, and those horror stories of the speculative stocks that someone put a lot of money into and it went bust for them.
Yeah.
Barbecue chats like that definitely scare people.
Yeah, absolutely. And it's, chatting to some clients during the week, and I'll do some videos on these for our YouTube channel around, you can invest into, a really high quality business, but depending on when you buy, it can be a bad investment for the person.
Yeah, of course.
So it can be the best business in the world, but if you overpaid in the short term to own Microsoft, it can be a bad investment.
Yeah.
So I'm going to unpack that as well.
Yeah.
So that I think, because I think investors focus on the negative, and once they get burnt in, say, the share market, they never go back.
No.
Never go back.
So it's short term as well. You're right.
And when you mentioned that, in the Wimmera, it's all about, I can see it. That's that's Australia wide. That's possibly global, but I know in countries like some of the European countries where they have long-term leases. They don't own their houses. They have a 30-year lease. Actually, they don't need to own their house.
Yeah.
And therefore they invest into businesses.
Yeah.
And that's obviously the Germans are very good at that.
I probably meant, when we're more, it's probably more just accessible for us to actually purchase properties here because the cheaper price range than in the city.
Yes.
People are more willing a little bit to buy shares because they can actually afford to buy them instead of property.
Yeah. Now, I suppose that some of the advantages or the benefits of borrowing to invest into the markets, you do get true diversification.
Yeah.
One simple ETF, the S&P 500 gives you exposure to 500 of the US biggest businesses. And so that's true diversification.
It is. Yeah.
So that's definitely an advantage.
Yeah.
Tax advantage, well, yes, the interest.
Tax deductible. We've talked about that forever and ever.
Yes, and obviously if you're based on the NAB Bank one, probably around 10%.
Yes.
And if it is the S&P 500, you might be lucky to get a 2% dividend return. It will be, I suppose negatively geared.
Yeah.
Yep, and you can pick how much.
Yeah.
How much you borrow. Yeah.
10% seems massive, doesn't it?
It's a big number.
Especially when you're hoping for, an average 10% return on an S&P 500 maybe.
Yeah, dividends plus growth.
Yeah.
Correct. But it's important to note that growth won't help you pay for your interest. And I think this is an interesting point. The question that people might ask is, how much should I borrow? And I think it's, okay, well, what can I afford from a cash flow point of view? So say if you're in one of these equity ones where you don't have margin calls, the only point that will get you into strife where you have to sell something down to pay the loan is I can't afford the cash flow.
Yeah.
So if you've got $100,000 in investments already, and then you're borrowing another $100,000, there's going to be $200,000 invested, bringing in $4,000 to $8,000 a year.
Yeah.
And can you personally, for your own personal exertion, cover that comfortably in any circumstances?
Yeah, that's right.
I think that's how people should assess what's a reasonable amount of money to borrow.
Yeah, if you're relying on the extra dividends that would come in from your margin or your investment, it's definitely not the way to go because they can end at any point really.
Yeah, well, that's right.
Dividends aren't locked in from every business every year.
Yeah, they're not compelled.
No.
And obviously your money, your own income from your personal exertion to keep these loans going. You also need decent income protection and so on to make sure that cash flow will not stop.
Yeah.
If you can't work. Very good. The risks.
Yeah. So like with leveraging for more amplified growth and amplified returns, you are, and we kind of just talked about that, amplifying the risk as well. If the investment drops in value, you've still got to be able to fund all of those margin calls or the interest, and you've just lost half the value of your loan in investment.
Yeah, and we can probably use the storm one as an example, just for fun. That let's say they take out $100,000 from. This is where people went to negative equity.
Yeah.
So that's where. It's a scary term that you'd borrow $100,000 from your home, and then so you've got $100,000 worth of debt, which goes into the market, into an ETF, and then you borrow another $100,000. Using that initial $100,000 that you borrowed, that's at double gearing.
Yeah.
And then the markets drop by, during the GFC, close to 50%. All of a sudden, you're $100,000 down, and of course. The margin call's going to come in, so they're going to start selling down stuff, and all of a sudden, back then, it eat away into the value of the person's home.
Yeah.
That they were in negative equity.
Yeah.
So disastrous. So these are the short-term things that can happen.
Mm-hmm.
Over a long-term, markets, perform beautifully. 10% on average over a very long time frame, but you have these huge shocks to the system. The short term, that's where the risk lies.
Yeah. And if you can't withstand those short term events with your cash flow, then you are setting yourself back.
Correct. They're the ones. That's where the risk lies.
Mm-hmm.
I think we've chatted about obviously the income side of things, margin calls, which we just chatted about. Obviously, I think
loss of collateral if you are
yeah.
drawing a line of credit against the home. The home, as with Storm Financial, is going to be eaten away at.
Yeah, and the bank may come for that loan because it's held as security.
Yeah. Foreclose the house.
The emotional side of things, Amy.
Oh, massive.
Yep.
I don't have the mental space personally to want to try a margin loan and think about all of these things.
So that's you at a personal level. Imagine the stress as a couple.
Yeah.
I
don't want to stress out, my partner by doing that either.
Yeah.
I'm happy to pay for anything I can out of my cash flow.
Yes. Yep.
And salary sacrifice and do, those superannuation tax advantages. But
so done carefully and very strategically, the nice part about doing it is you can kick off with the first margin loan I did, which was March 2003, was $80,000.
Yeah, it's up to 70% generally, is it?
Yes, yeah. Generally, and sometimes lower, depending on the stocks. It doesn't have to be 400 grand.
No.
You can start off small, pay off, borrow again.
Yeah.
So using debt, particularly to buy high quality businesses, whether that's a private business or via the markets, over the long term is a very good thing to do.
Yeah.
But you've got to do it in a way that's it doesn't break you in those times where the market really gets hit hard.
Yeah, investing into those quality rather than the speculative businesses.
Yes, absolutely.
Definitely go a long way.
Yep.
And so I don't mean to shit on the idea of it personally. Yeah, I've got family that do it and love it and have the mental space for it. I just
and borrowing $50,000 would not stress you.
No.
But this can happen over time. So the amount of debt can grow with the amount of equity.
Yeah.
You work out your percentages of total. You can work out your percentage based on the income draw. What you pay.
Yeah.
With dividends and how much you need to chip in personally.
Yeah.
As the portfolio grows, the debt level might stay the same. You can do it safely and progressively safer. We're at a stage where the portfolio will fully support the loan and the interest payments.
Yeah, definitely.
And can look after it in any circumstances without the help.
Yeah.
Yeah. So it's definitely a tool, and I think it's worth noting that you can, without having to go to the bank and organise these other ways of borrowing, you can actually go and buy a fund that has internal gearing within it.
So it might be a cheap fund, I'm imagining.
Well, exactly. The one that I think about is the Colonial First State had the Australian Geared Share Fund.
Yes.
It's had it for a long time.
Yes.
And it's I think approximately, it's not one that I've used, 50-50. So there's 50% gearing there.
Yeah.
And when the markets are going well, it's red hot.
Yeah.
When it's down, it's not. Yeah.
I remember a client actually had a self-managed super fund and had a colonial product inside, and it was in this gearing scheme.
Yep.
And I remember doing the comparison of fees before and after going without product and without this ETF, and it was massive. I remember
the costs,
fees on that geared scheme, because there's a lot of management that needs to go into that.
Yeah, and obviously that includes the interest. Was that within the fee structure, the interest side of things?
There would have been a portion of it, I'm sure.
Yeah, yep. So but with those products, it is a relatively safe way to do it, because it's all packaged up, so you won't get a margin call or hey, unit holder, you need to send us some money because we're out of shape.
Yeah, it will never affect your personal cash flow. It'll just eat away at itself.
Yeah, and we've mentioned Storm Financial, but there's one back in the GFC called Opes Prime, where the stockbroker or the financial planning business, I think they're more stockbroking, where they take collateral, but they bundled everyone's collateral together and then went to the bank, which was ANZ and Merrill Lynch at the time, if my memory serves correctly. Yeah. And there was people there that signed across their collateral with a view to borrow some money in the future, but never did. But their collateral got bundled up with everyone.
Oh, no.
Opes Prime got out of shape in terms of their borrowing agreements, and people's stuff was sold regardless whether they had drawn down on their debt or not. So,
Wow.
debt creates a lot of problems.
Definitely.
Only when things go bad. And I think that's what's Warren Buffett's famous saying, you know who's swimming naked when the tide goes out. Yeah. So he's got a beautiful way of saying things.
He does.
Fantastic. Well, Amy, I think that's probably plenty on borrowing. There's lots of ways to do it.
Yes.
Please seek advice.
Yeah, and if you are definitely interested in doing it, make sure you check out the product. So even the NAB Equity Builder, again, not invested in NAB or not, but it'll have all of the risks, the pros and cons on each website and tell you what specific investments are or are not allowed to be purchased with the loan.
Yeah.
There's a lot of fine print there and it's worth reading.
Yeah, seek financial advice from not someone that's got a conflict. And you can't charge asset-based fees on borrowed money.
As a result of the Royal Commission?
It would have been that, I've only just remembered that point, that you, and that obviously takes away the incentive to create money via debt to invest for clients. You could not have asset-based fees, so that was another change that came in not long after all the shenanigans of double gearing and Storm Financial.
Yeah.
All right. Thank you for listening, everyone.
Thank you.
Catch you next week.
Bye.
Bye.